Today on the podcast, I sat down with Brooke Pollack, the founder of Hutt Capital, a leading blockchain fund-of-funds and asset management platform. Brooke was an early mover in the fund-of-fund space, and he's thoroughly traveled not only the blockchain idea maze, but the idea maze around fund structuring within this blockchain and crypto ecosystem. This conversation was a lot of fun, so without further ado, here's my conversation with Brooke Pollack from Hutt Capital.
Matt Walsh and Nick Carter are partners at Castle Island Ventures. All views expressed by them or the guests on this podcast are solely their opinions and do not reflect the opinions of Castle Island Ventures. You should not treat any opinion expressed by anyone on this podcast as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of their personal opinion. This podcast is for informational purposes only.
Brought down by bad mortgage investments, Lehman, which has 25,000 employees, will be liquidated.
The federal government loans American International Group, AIG, $85 billion.
This is a different kind of market, and the Fed is asleep.
The federal government is stepping in to stabilize Fannie Mae and Freddie Mac, the two mortgage giants that have been threatened by the housing crisis.
The Bank of England has pumped £75 billion more into Britain's ailing economy with a new round of quantitative easing.
You print a couple $1 trillion, and all of a sudden, people start to worry. So out of this worry, we have something called the Bitcoin.
Brooke, well, thanks so much for joining the podcast. I can't believe we haven't had you on. Excited to have you on the podcast.
Yeah, thanks so much, man. It's great to be here. It feels long overdue, so excited for the conversation.
Well, there's definitely a lot going on in the space. Maybe before we dive into all of it, could you just tee up your background and what was your path to becoming a fund entrepreneur with Hutt?
Yeah, of course. So, before doing this, I spent a decade working for, global investment firms in the traditional private markets world. So I actually started my professional career 3 weeks before Lehman crashed in 2008. And, that may or may not have made me a bit jaded on our financial system. But either way, it was great timing because our firm put a hiring freeze on 3 weeks later. And I was working for a family office consultant, basically helping, ultra high net worth families to invest their portfolios with a specific focus, in my case, in the private market. So all sorts of different types of, closed-end funds, which included venture, but also buyout and energy and growth equity and credit and real estate and a bunch of things. After that, spent some time in the secondary world with a firm called Hamilton Lane, which has a large advisory and asset management business, mostly working more with endowments and pensions and sovereign funds, and spent my time on the secondary side. So we were kind of trafficking in the trading of private fund interests, doing GP restructurings, basically buying portfolios of private assets managed by third parties at the end of the day. And I did that for a couple of years and had the good fortune of getting into venture full time in 2014 with a firm called Greenspring Associates, which I guess as of a year ago is now part of Stepstone Group, but was independent while I was there. And, spent my time there investing in venture funds. So they're a large kind of traditional venture fund of funds platform. And, investing in funds, a lot of the brand name funds folks would be familiar with, spent a lot of time on the emerging manager side, which is a little more intellectually stimulating, helped to build out their secondary business, learned the direct side of the business while I was there as well. They have a large kind of direct kind of growth equity business. And, spent a little over 4 years there working across the platform. And, in the meantime, had got really interested in the blockchain and crypto space. I guess the quick backstory there is I went to school with a couple of guys who, post graduation later on became, early folks in the Bitcoin world, started early companies in the space. And really just from a personal perspective, at some point I was like, okay, well, what are these guys up to? Kind of caught my attention. And, caught up with one of them in late 2014, walking me through just why Bitcoin is fundamentally interesting, like how to use a crypto wallet, like pretty basic stuff. But it was the first time that it really clicked. And, there wasn't much for me to do with it from a day job perspective at the time. But that really changed in 2017. For the first time, we started seeing a lot of these blockchain venture funds emerge. And, there were a couple out there that were in existence before that. But, kind of the quality and quantity really started to increase at that point. So I basically just decided, hey, I'm going to go out there, get to know all these funds, really build out my network and relationship in the space and, spearhead Greenspring's efforts in the space last year. I was there and basically just became convinced that this space was the future. Just found it far more, both intellectually and financially interesting versus everything else going on in this space. And, I'd always wanted to do something more entrepreneurial. I had some other ideas in the past, which frankly were pretty awful, which luckily I didn't pursue. And, finally found both the overlap of passion and what I felt like would be a great idea, and ended up leaving Greenspring to start Hutt Capital, which, we obviously can get more into, but started Hutt Capital in 2018.
It's a great journey. It reminds me a lot of my journey being at Fidelity. And I went through this process of just sort of unlocking insights, I guess I would say, around how big this industry could be. So sort of started with Bitcoin, and then after Ethereum launched, started to get a lot more excited about some of the things that were being built on that network. And over time started to see that the addressable market for this stuff was going to be, a lot larger than I thought a year or two before. What was your process like in terms of just realizing the market potential for blockchains and why that might be something you want to build a franchise around?
Yeah, for me, what really got me interested in the space originally was, the idea of monetary experiments being possible through, open source money in a way that was never possible before. So, obviously anyone can kind of go out and fork the Bitcoin code, and most of those efforts were not super exciting, but in theory, anyone can go out and kind of create these monetary experiments. I just found that very kind of exciting from a personal perspective, and the idea of applying these open networks, permissionless systems to other categories, I found extremely fascinating. Obviously, the idea of being able to, build those on new smart contract platforms and, not solely being, kind of a singular kind of Bitcoin centric industry. We declare we're very bullish on Bitcoin and very fundamentally extremely interesting. But, kind of seeing that there was a much bigger industry to be had here, kind of really got me excited. And part of it in terms of starting a new firm, I'm sure there was some naivety in terms of doing that in the middle of 2018. That was a very interesting experience from that perspective. But from like a business standpoint, I was looking out there, okay, there's like 50 early stage venture firms. Like, okay, we're not going to be the best early stage venture firm if I was to go out and start, an early stage venture fund back in 2018. But, looking at my background, relationships that we had, I felt very strongly we could be the best blockchain venture fund of funds platform. And that got me really excited too. Just the idea of actually, going out and building something that was unique where we could be the very best at doing it, really kind of got me over the hump as well in terms of, leaving to start a new business.
And certainly you had some great experience before that you articulated around working at other asset management firms that had done fund investing and direct investing. So how does that inform what you want Hutt Capital to look like in terms of your investment strategy?
Yeah, so I guess for us, it's kind of, an overlap between both being institutional. I spent 10 years basically working for institutional private markets firms and LPs and fund of funds, and kind of taking that institutional background and applying it to a new space. And, having been in this space, full time or spending way too much of my time since, I guess, 2017, kind of combining that institutional background with a more crypto native approach that's, necessary in a space like this. So that frames a lot of what we do. Likewise, have seen in the venture world, I think, the idea that venture returns fundamentally are not scalable. And, that factors into a lot of what we do as well. So, as a fund of funds, folks can kind of see on our website a lot of the firms that we work with. But, we've purposefully shied away from some of the very large funds. It's not a judgment on quality. It's purely a judgment on how we believe you generate outsized returns in the venture capital world. So we do have a focus on, let's say, more modestly sized funds as a result of that. I think another thing, well, I guess maybe a couple of things that have been, really learned from that experience. One, in terms of building a fund of funds, you really just can't be a fund of funds anymore. We've seen that play out in the traditional world where, over time, it ends up just being kind of a race to the bottom on fees. You really need to build a diversified platform where, you use the fund of funds to also generate, deal flow on a secondary basis and direct basis, and kind of build this broader platform, kind of anchored by the fund of funds. So, for example, we are also a secondary investor. We also make direct investments in companies and protocols. And, that's kind of a very fundamentally important part of our platform to build something that's long-term and sustainable. And, probably one of the key items is just like the idea of differentiating yourself as an LP. I've worked at places that were both very good at that and very poor at that. I guess very, very poor at it, just more passive, I guess you could say. And, seeing some of the groups that are more innovative and kind of pushing boundaries on that has really led me to believe that that's very important. And yes, we've, aside from things like, maybe passing along deal flow or helping with some operational things, we've also kind of tried to be much more proactive in terms of, building out partnerships with, folks that train developers and try to help them get placed with our portfolio companies and those of our managers, building a partnership around like providing liquidity to early stage protocols and, likewise helping the investments of some of our managers from that perspective. And, kind of continue to think through how do we really differentiate our capital and kind of push boundaries forwards from that perspective. And, ideally in a more crypto native way, again, given what our focus is.
Yeah, that's great. And certainly that's a huge value add. So we were raising our fund at the same time that you were raising your first one in 2018. And the landscape was a lot different in terms of what types of questions LPs asked, how sophisticated LPs were generally. And I'd say back then it was much more of a family office, high net worth individual type of LP roster that was comprising a lot of the crypto funds. But there was an education journey. So I guess generally speaking, what's your assessment of quote unquote institutional LPs right now in this landscape in terms of how sophisticated they are around crypto, and then how far along they are on their deployment schedule or cycle towards crypto-focused funds?
Yeah, I feel like, if you look back, for the past 4 or 5 years, I feel like it's been a slow, continued journey amongst the institutions to, get up to speed, go through the education process, and then start deploying in this space. So, you continue to see more institutions deploying into this category, largely either, one, just owning Bitcoin directly, potentially Ethereum, potentially one or two other assets, but primarily Bitcoin and Ethereum. And then, also primarily through venture strategies. At first, there were, a couple well-known funds in the industry that were commanding almost all the institutional capital that came into venture funds in this space. And, alongside institutions being more active, we've also seen, more willingness to go out and invest in funds that are not, kind of like the well-known, very large brand name funds, and, be a little more creative and really dig into the industry and try to figure out, okay, well, what do we believe is the right strategy? How do we think you best approach the space? What does that lead to in terms of, what fund or funds that we should be working with? So, the institutional capital is much more spread out than it used to be as well. A big difference between what we see today and back in like 18 and 19, as you and I were talking about earlier, is that, in 18 and 19, it really felt like the institutional capital, with a few exceptions, became significantly less interest in this space. I think there was general consensus that, okay, crypto's dead, and, there just wasn't a whole lot of interest to deploy. And things really slowed down. And you haven't seen that happen right now. And, in kind of this current bear market, you continue to see institutions deploying. You continue to see institutions really interested to get up the learning curve and get educated and, understand the landscape of funds out there and, kind of get to know those managers. So, the general feeling in talking to groups like that is very, very different than it was the last bear market. I feel like there's a realization that, hey, this industry is here to stay. It's not going away. You can debate what it looks like in the future and what form that takes, et cetera. But this is going to be a real thing that we need to seriously consider for our portfolio. So that's been, really good to see. And, things are maybe a little slower right now. Obviously, it's always tougher for an institution to maybe get something through their committee in a bear market than it is a bull market. But very much a temporary, matter from that perspective in our view.
I totally agree. I'm kind of chuckling because I remember back in, I guess it was the end of 2018, maybe early 2019, the price of Bitcoin had fallen to something like $3,500. And I had an LP say, just kind of matter of factly, like, oh, it's too bad. Like, too bad none of this stuff worked out. Like it's all kind of over. I was like, no, like don't worry. We're just in a bear market. These things happen. But this time around, it is quite different. I mean, we have LPs that are calling and saying, what is the best asset in a certain category? What's the best company in a certain category? Are there any secondary opportunities? And so it just feels like a much different bear market experience this time around. Yeah,
very much. It does feel like a lot of, investors we talk to on the kind of institutional LP side, realize, all right, well, if you are of the mind that this industry is here to stay, this is actually a great time to be deploying. And valuations are down significantly from 6 months ago, et cetera. And yeah, likewise, that's not really something that we heard back as much in 2019. So it is nice to see. We spend a lot less time on education these days than we used to, which is nice.
One of the fascinating things, just from being a GP perspective, has been to see the proliferation of new types of blockchain strategies. So you have funds now that only do blockchain gaming. You have funds that are focused on buying NFTs, and so there's a real concentration here that's happening. And very rarely, I think, do you see funds that say they do everything. I mean, that doesn't really exist anymore. So how does that inform how you think about portfolio construction across Hutt?
Yeah. So, I mean, the short answer is significantly. And yeah, to your point, so 5 years ago, you go out, you pick a blockchain VC fund, and they're probably going to cover the entire universe because there, frankly, wasn't that much to cover at the end of the day. The application layer was just getting going, and it's a much smaller world than it is today. And yeah, to your point, as the industry grows, we start to see a lot more specialization. You just can't cover everything well like you used to be able to do. So we see NFT funds, gaming funds, DeFi funds, DAO focused funds, and et cetera. And for us, we're very holistically focused across the ecosystem. Our general goal is to provide diversified exposure to the top startups, across sectors, across geographies, across structures. And yeah, I mean, you really just can't get that through a single fund anymore. So our goal is to find, okay, who are the best players in all these different categories? Who's best in the gaming space? Who's best in the DeFi space? Who's best in the NFT space? Who's best on, let's say, NFT infrastructure? There are funds out there also just buying NFTs directly. And is that something that we want exposure to? And, who's the best outside the US and all these different categories, and, kind of put together this, all-star roster of funds that we believe are best in breed in their different categories. And, there's still funds that are not as specialized that, we work with and are extremely excited about that, tend to be writing first checks into companies or protocols, but with a more, diversified focus across different sectors. But yeah, so yeah, that's kind of a little about how we think about it. But again, it's something we have the luxury of doing as a fund of funds. If you're trying to pick a single fund, you're kind of forced to decide what part of the ecosystem you want exposure to just by nature of how that's evolved. So, we have the luxury of kind of going out and picking out, the top funds that we see in these different categories.
It's definitely a huge benefit of a fund-to-fund structure. And I mean, the other benefit that I think is less obvious, but is definitely a factor in this market, and would love to get your thoughts, is just the state of a lot of these funds being very oversubscribed, which was definitely not the case in 2018. But, many of these funds that I'm sure you're seeing are generally capacity constrained. They're doing early stage investing. You can't run some of these strategies with $1 billion fund. It just wouldn't make sense and wouldn't move the needle. So talk a little bit about what you're seeing there. And obviously you're getting great access. So talk about what that process looks like in terms of getting that access.
Yeah, of course. And yeah, to your point, I mean, that is a big fundamental change from, 2 or 3 years ago where, back in 2019, anyone could basically get access to any fund because there just wasn't the demand of capital to be investing in funds in a way to really drive, the type of oversubscribed funds and, very difficult access like you see in the traditional venture world. And that's changed really in the past 18 months, kind of starting, I'd say early in 2021, where we started really seeing a pickup in institutional, in particular, demand to invest in funds in the space. So, what that led to is basically all of the good funds became very oversubscribed, turning away LPs, many of them could have raised, multiples of what they did. And, for us, to your point, being able to offer access to those funds is a very kind of, fundamental value proposition that a fund of funds offers. And, we're very fortunate that we have, very good access across the ecosystem. But how does that work as a fund of funds? How do you try to get access to these funds? Part of it just goes back to kind of relationships and reputation of the space. I mean, we've been doing this since 2018. So a lot of these folks are just people that we've gotten to know over long periods of time who want us involved, enjoy working with us, kind of being, long-term patient capital that, people know isn't going to get cold feet because, we're in a bear market, so we don't believe in this space anymore or something like that. And, as a young firm, that can get you a long ways. But fundamentally, like as I was describing earlier too, we really do a lot of work and effort to differentiate our capital as a fund of funds why are we doing that? One, to get better access, and then two, to get more allocation to these very oversubscribed funds. So, a couple of like the things I mentioned earlier in terms of, providing deal flow, helping like operationally and various things of that nature, helping with developer talent and providing liquidity and things of that nature. And, really kind of continue to look for different ways that we can help from that perspective to ensure that we continue to get the access and allocation that we want in the future. But we talk to LPs all the time who are, trying to get into funds that we've worked with for a while and are way oversubscribed and they can't access. And I think it's only going to get, get worse, worse in terms of trying to be a new LP getting into these funds. A lot of these funds are still relatively lesser known, in terms of like the broader institutional LP world. Like within crypto, they're brand names, but within the broader institutional LP world, they're still relatively lesser known. So as more folks kind of come into the space, get to know those funds, they're only going to become more difficult to access. We kind of see this as a one-way street from that perspective.
I think it's definitely a one-way street, and you can almost do it from the bottoms up where, it just doesn't make sense to be investing in a $1 million pre-seed round if you're running a $2 billion fund. I mean, it just doesn't move the needle. And so I think these capacity constraints, this oversubscription dynamic is definitely pervasive. And certainly from where we sit, having partners that are long-term aligned and aren't going to get spooked in bear markets goes a long way.
Yeah. And, another piece that another dynamic which that has led to is from 2-3 years ago, you couldn't really have a mega fund, generally speaking, there just wasn't enough demand out there to drive that. And at this point, the best funds can raise a lot of money. So, you now have a situation where kind of the folks that want to have these very large funds, kind of build out these large platforms can now actually do it. And there's a lot of like temptation for managers to go out and raise more money. So, you learn quickly kind of, who is going to be more disciplined on fund size, who does want to build a large platform, and kind of that dynamic as well has changed a lot over the past 3 years.
One of the things that you've probably seen a lot of is just different choices around how to design a fund. A lot of these funds in the early days were actually hedge funds that were doing illiquid deals out of a hedge fund structure, and some of those didn't work out well. So just generally speaking, what's your view on open-ended versus closed-ended versus hybrid funds in the crypto space?
Yeah, so our firm invests, so historically we've invested solely in closed-end funds. And for us to invest in an open-ended or hybrid fund, it would have to be a pretty significant exception for us. So, I guess that tells you, where I'm headed with this answer. But, we believe very strongly in the closed-end venture model in this space. And, probably one way to answer that would be to kind of describe some of the concerns that we have with open-ended and hybrid funds. I guess on the open-ended fund sides, having talked to a lot of funds who have gone through this, like there's just a lot of structural complexity trying to do a lot of illiquid deals through an open-ended fund and having all these different side pockets and, which LPs have exposure and just, operationally is a bit complex. So, there's some benefits to not having to worry through that. More fundamentally, this is a highly volatile category. We can see what's happened over the past 2 years in terms of prices. Things go up a lot, they go down a lot. And that's kind of part of the cycles of crypto. And that leads to certain issues for open-ended funds in terms of retention and alignment from our perspective. On the retention side, let's say you're a crypto open-ended fund of some sort, liquid VC fund, hybrid fund, whatever it is specifically. You have annual high water marks, typically anyways. And if you're up a lot in a year and then down a lot the next year, so let's say last year and this year, for example, so far for a lot of open-ended funds in this space, how do you continue to retain talent when your high water marks are so much higher? What we've seen historically is that that's very difficult. And, your management fees can fluctuate pretty significantly during the course of a year or, over the course of a couple of years based on, what the markets are doing and your NAV kind of going up and down as a result. So, that's been a big issue historically. You saw a lot of that back in 1819 too, where a lot of hedge funds, just they lost pretty much their whole talent bases because of that. From an alignment perspective, last year and this year is a great example as well on that piece where, so a closed-end fund, the carried interest is taken basically at exit. So what's standard is that a fund has to return, all of the called capital, and only after that do they start generating carry on a realized basis. You basically split proceeds with LPs going forwards, whatever the carry split is. And that, that's going to take a few years typically, give or take. For an open-ended fund, they take, annual carry based on their NAV. So what that means is like a year like last year, open-ended funds were, pocketing realized carry, a lot in pretty significant amounts, which is fine. But what you've seen now is that a lot of those funds are now down significantly this year. And so their LPs are down, but the GPs in the meantime realized a bunch of carry. And there's just a lot of lack of long-term alignment concerns that we have, especially in such a volatile space. We've seen funds, for example, who did really well with Luna last year. Obviously, that imploded this year. So a lot of those positions, if not realized, went to basically zero. But a lot of open-ended fund GPs still realize carry on those investments. I'd say what they should be doing is returning that carry because that would create clearly much better alignment and is the right thing to do with LPs. But with a closed-end fund, let's say that exact same scenario happens. Sorry to belabor the point here, but just I think it's helpful to go through. The same thing happens. So let's say closed-end venture fund invested in Luna, it was up a lot last year, went to zero this year. They realized no carry because, unless they maybe realized profits on that and were above their 1x DPI already, you're much more aligned with how you generate carry and how your LPs make money long-term. That's another concern for us. I guess the last one, just fundamentally, is that if things go well, an open-ended pool of capital gets large quite quickly. So let's say you got raised 100 million and, you 3x it again, you're at 900 million. So investing a $100 million fund, $900 million fund are very different. And, one of the benefits you have as a closed-end fund is you can reset every fund. So you could say, hey, we're raising a $100 million fund. Okay, well, now we'll go raise another $100 million fund, or, often funds will get bigger, but you have control over that. If you're open-ended funds, things go well, you get large quite quick. And, the ability to repeat historic returns becomes more and more difficult as they grow. So, that's another concern for us. And I think if you're in on one of those funds day one, like, okay, well, become a victim of your own success. There's worse things that can happen. But if you're looking at those funds, they open themselves up or they're kind of consistently open, what you end up buying into is, largely a liquid crypto portfolio of kind of more mature liquid assets that they've done very well with so far. And you're not really buying into like fundamentally an early stage portfolio where your capital is going towards, funding early stage, new companies and protocols that they're excited about. So, likewise, that's something that is less compelling for us. And if we were going to do something like that, it would have to be backing a fund on day one. I guess alternatively, you could say, in a bear market, there could be a situation where you could try to take advantage of that as well. But obviously, we have some kind of broader fundamental concerns as we've outlined. So yeah, it's a bit of how we think about it. And I think the last thing to mention is like on the closed-end venture side, you really have a lot of flexibility in terms of what you can invest in. Assuming you're structured such that you're not capped at 20% of your assets going into token structures, you can basically invest in whatever you want. You can invest in equity, you can invest in illiquid tokens, you can invest in liquid tokens, and you kind of have the flexibility to go across these different structures as you see fit, which I think is again best done through a closed-end structure.
Yeah, it's a really good answer, and certainly agree with the size dictates the strategy. So if you're a $100 million fund versus $1 billion fund, it's just fundamentally your investment strategy has to be a lot different. Do you see any opportunities out there for just liquid token funds and more venture-oriented liquid token funds? And I guess the reason for the question is there is this dynamic where a lot of the venture funds who are investing pre-launch, so to speak, they're not going to be holding these tokens necessarily for 10 years. There'll be at some point where there will be pressure to sell, return capital to LPs. And there is sort of a gap in the market there around tokens that already exist and, may still have a venture return in front of them. But investors are already up 50x from the pre-launch or the convertible note round, maybe they won't be hanging on for that extra leg. So curious what you think about that pocket of the market just around funds that only buy liquid tokens.
Yeah, man, I do think there is a place for that. Like whether it's a fit for our mandate or not is a separate question. But I do feel like there's a gap in the market, for groups who can do really deep fundamental analysis for, let's say tokens outside the top 50 and the kind of like, longer tail assets that, there's a lot of like really high quality projects out there that are not very well known, have relatively low market caps. And, if you can kind of do that like deep fundamental analysis, kind of, let's call it a stock picking portfolio for lack of a better word, I do think that's a pretty interesting strategy. And I don't see a lot of funds pursuing that. Yeah, we've seen a small number, but I do think for funds who have that capability, it's a pretty compelling model to chase. And, I think it'd be a bit differentiated market. I also think in general, to your point, like, there's not really like the same structural capital to continue supporting liquid assets, outside of like these kind of like top 10, top 50 indices. So, it'd be great to see more of that as well. I don't think there's necessarily a near-term fix for that. But I think the fact that there isn't a near-term fix probably means there's more opportunity for those types of managers that we just described as well to find success if they're good at what they do.
Yeah, I think there's a lot of those pockets. I was talking to someone the other day, just even around private equity. So you haven't even seen private equity really meaningfully enter the crypto space. And at some point, they probably will be. So I guess it's the nature of the opportunity from an asset management perspective that a lot of the categories, whether that be secondaries or fund of funds or private equity even, they'll start to exist in the crypto space at some point.
Yeah, you're definitely seeing the big private equity firms start to dip their toes in. I think there's going to be a lot more of that over the next couple of years. But yeah, to your point, what activity has been tangible there has been pretty limited. So I mean, yeah, like just from a long-term perspective, it's just still so early from like a capital formation, kind of capital market funding perspective in terms of the types of capitals that are coming into the space.
One of the things that you must get asked a lot of questions about is just regulation. And I guess this was a lot less clear back in 2018, but there are still parts of this market that are pretty unclear, frankly, from a regulatory perspective. And so how do you think about that in terms of underwriting risk, just general regulation?
Yeah, I mean, in a way, we try not to overthink it. Given we are a diversified fund of funds. We make direct investments as well, but kind of focusing more on the fund of fund side of things. Like our job is to go out and find the best managers who have access to the best startups. And, our job really remains that regardless of changes in the regulatory environment. Likewise, because we're pretty diversified across the ecosystem, we have exposure instead of like a single fund we're going to go invest in, 25 or 30 startups or whatever the number might be for a specific fund. We're going to have exposure to hundreds of startups. So, any single company or protocol, that runs into regulatory issues is kind of inherently less impactful. Obviously, if there are big, major regulatory changes that impact everything, that impacts us, of course. But I think a lot of that, like regulation's always been a risk in this space. It's going to continue to be a risk for a long time. It's difficult to mitigate that unless you want to say, hey, I'm worried about DeFi risk, in terms of like, hey, what happens if, the government starts, regulating like non-KYC, like DEXs and wallets and stuff like that. But at the same time, like we're just very fundamentally bullish on DeFi and, we're not going to not invest in that category because there is a potential for regulatory concern. We think the benefits of that outweigh the risks, I guess, given the model we have. So, it doesn't have a huge impact on how we deploy. Like we track it very closely. Like it's obviously important to understand what are those risks, kind of where are the key categories those risks exist. What's more sector specific, kind of like what's bigger, like in industry fundamentally changing type of stuff. But yeah, at the end of the day, it doesn't frankly impact our strategy a lot. That could change in the future. Obviously, there are things that can happen that would change it, but at least historically, that hasn't been the case.
And I guess on one angle, one of the key regulatory risks, if you even want to call it a risk at this point, is just some of these tokens being securities. And I guess the good news is that if they are securities, then at least you have clarity on how they ought to be traded. And perhaps that market size is a lot larger, which I suspect it is, in terms of broker dealers that could now trade these things. And so it's really just the clarity, I think, on who controls and regulates the spot market. Is it the CFTC? Is it the SEC? And can we get a little clarity here on whether or not some of these things are securities or commodities? And, then at that point, I think you just have a lot more capital that is freely flowing into these systems.
Yeah, we agree. I mean, we talk to people all the time who are, let's call institutions or institutional investors who, they would like a lot more clarity on this stuff before they're going to get more involved or, place a larger amount of capital potentially in a space like this. So I do think there are a lot of folks who would really enjoy that clarity, and it would lead to more capital formation, more capital coming into this space as well. I mean, yeah, we hear that pretty regularly. So generally have the same assumption.
Well, you can always wait for the clarity, but it would be like waiting for like 2005 in terms of internet investing. You can wait until you have the full clarity, or you can start to dip your toes, which we're all doing, obviously. I'm curious just what the big narratives you see driving sort of the next few years of growth in this industry. It's obviously a hard question because things come out of nowhere. DeFi popped out of absolutely nowhere when it first started, really. But where are you seeing the most time and attention and just entrepreneurial passion? And what are you looking towards in terms of just the future growth of the industry?
Yeah, I think, we've kind of reached the point as an industry where, there's going to be continued growth in infrastructure, and people are going to continue to come out with new layer one blockchains and, kind of some of the more infrastructure and building block types of things. But yeah, I think we've reached the point where, to really continue to get people excited, we need to continue to show them, okay, well, blockchains exist really just as infrastructure to build on top of. So what are you building on top of them? And, kind of this application layer, which, historically has largely been, DeFi and NFTs. And yeah, I think you need to continue to show or, build things that people want to use on blockchains. And that could be, some of those same categories, whether it's DeFi or NFTs or gaming, or those are all categories that we're really excited about. But things that, consumers want to use because they're fun and interesting or have some sort of fundamental value proposition without caring quite as much kind of what's going on behind the scenes. Like, I'd love to say that I think fundamental privacy is going to drive a ton of usage, but like historically, I haven't really seen that be the case, even if it's something that we think is incredibly important. Usually it's driven by kind of really interesting consumer use cases. So, we see people building out social networks on blockchains and other kind of decentralized applications, like, some things around like more like physical and wireless infrastructure and things of that nature. And I think to really get a growing pie of people excited and, kind of wanting to come into the space, need to find or, show that we can have growth in use of blockchains to do real things. Where do I think that growth will come from? It's hard to say. Like, to your point, a lot of things happen to pop up. Like, it could be things that don't even exist right now or no one's really thought of or no one cares about. Yeah, I think a lot of that will come from some of the existing places. Like, I think one of the beautiful things about the NFT space, while, it's an interesting category, like, it creates something fun and interesting that consumers can do without really caring about what's happening behind the scenes. So looking at things like that, things like NFTs, areas like gaming, areas like, social, for example, I think those are categories that could bring a lot of users into the space and really help to drive kind of those future narratives around this category. We're super bullish on DeFi, but it's a bit more like complex and confusing to your average consumer. So, I think that'd be more of like a back end used by, at least in the near term, kind of companies that are gaining a lot of consumer adoption and kind of have that broader traction. So, and that's some stuff that we believe would need to happen. Like, like personally, kind of putting on like my investor nerd hat on, like, I'm pretty interested in like the idea of new forms of capital formation. And that could be like, venture DAOs or guilds or just new models that are coming out there to basically fund startups at early stages. I think that stuff is pretty interesting and have been kind of diving into that world a bit. But I'm not sure that's necessarily going to be, driving tons of users into the space relative to those other categories.
It's interesting because it could if it's fused with NFTs, I think, because, NFTs really is just the addressable market there is gargantuan. When you think about, you're just talking about provably scarce file types, and that can represent a ticket, that could represent a receipt, that could represent an ownership stake. So one of the things I've been thinking a lot about lately is, are NFTs and just NFT financial market infrastructure, will they be the backbone of all of these private blockchain attempts from years ago that never worked? It's just now they all work on NFT infrastructure because it's open, it's interoperable. And you could imagine a lot of capital being formed either in a regulated context or through even like anonymous DAOs using NFTs as a primitive for pseudo equity ownership in things. So I would agree with you on your bullish sentiment on NFTs. I think we're probably just scratching the surface in terms of what this is going to be used for.
Yeah, I strongly agree. And you're just starting to see kind of more creative use cases of NFTs outside of art in terms of what you can do with them. And from a funding perspective, we've seen startups using NFTs as a funding mechanism, which introduces other questions as well in terms of if we're trying to get access to the best startups, what does that structure look like? What type of instruments do you need to be investing into, to gain that access as things get more creative from that perspective. But yeah, that's been quite exciting to see.
Well, this has been great, Brooke. I feel like we could riff for hours, but where can we send people to learn more about Hutt Capital and follow what you're doing?
Yeah, so our website's huttcapital.com. You can find us on Twitter. We're not super active, but at Hutt Cap. And you can find it through the website, but we also have a Medium page, which is medium.com/@HuttCapital, I believe. And yeah, feel free. I guess I think my email might be on our website, but those are the best ways.
Awesome. Well, thanks so much for joining us today. We'll have to have you back on soon. Appreciate the time.
Yeah, this is fun. Thanks so much, Matt.
Thanks for listening to another episode of On the Brink with Castle Island. To find out more about Castle Island, visit castleisland.vc. To listen to all of our podcast episodes, please go to onthebrink-podcast.com or just click on the tab in our website. Thanks for listening.